Welcome back to the deep dive. Today we're really cracking open the financial engine of Roper Technologies. We'll be analyzing their Q3 2025 results and looking at their, well, pretty aggressive strategic playbook. This isn't just about software. It's about how this kind of decentralized group of niche businesses deploys billions and turns it into predictable cash flow.
Exactly. That's the mission today. We need to get past the headline numbers, look at the earnings presentation, the press release, and figure out how durable this model really is.
Yeah.
And like you said, with all the M&A, we absolutely have to focus on those non-GAAP metrics, the adjusted results. That's where you filter out the noise from acquisitions and see the real operational earning power underneath.
Right. And the top line numbers, they certainly look strong. Roper delivered what they called a strong quarter. Total revenue jumped 14%, hitting $2.02 billion. Adjusted EBITDA was up 13% to $810 million. But the number that, for me, always defines Roper is the cash flow. Free cash flow up 17% to $842 million.
That's it. That's the ultimate proof of their thesis, isn't it?
Yeah.
I mean, you look at the trailing 12 months free cash flow. There's a 17% compound annual growth rate over the last 3 years. That tells you pretty much everything. It's not about one single strong quarter. It's about building a machine designed to acquire great businesses and then just optimize them for cash. That compounding is the core value here.
Okay, so let's unpack those headline figures. That 14% total revenue growth, how much was, organic strength versus acquisitions?
Yeah, it was definitely tilted towards acquisitions this quarter. M&A contributed plus 8% to that growth. That signals some major activity, which I know we'll get into. But importantly, organic revenue still added a very solid plus 6%. Now, to really grasp these results, we do need to talk about those non-GAAP adjustments.
Right, the adjusted DEPS and adjusted EBITDA they focus on instead of the standard GAAP metrics. For a company buying stuff all the time, why is stripping out these specific costs so central to their story?
Well, it's absolutely crucial. If you only looked at their GAAP results, honestly, the company would look kind of structurally expensive, maybe even inefficient. The main reason is this huge non-cash expense.
Yeah.
The amortization of acquisition-related intangible assets is massive. When Roper buys, say, a vertical software leader, they put a huge intangible asset on the books, customer lists, code, brand name, all that. And accounting rules say they have to amortize that value over time. That expense just crushes GAAP net income.
Okay, so they remove it to show the underlying performance after the deal is done, but before that accounting charge hits. Makes sense. What else are they adjusting for, typically?
The other two main ones are transaction-related expenses, the direct costs of doing these big deals, and then the financial impacts from their minority stakes, specifically in Indicor and Certinia. So by adjusting for those three things, they're basically showing the earnings power as a pure cash engine, which, as we just said, is really their defining feature.
Right. And that brings us to their adjusted diluted earnings per share, or adjusted DEPS. That was up 11% to $5.14 for Q3. And it was interesting, they specifically called out that this number included a 5-cent negative impact from Q3 bolt-on deals that weren't in the previous guidance.
Exactly. That detail, it seems small, but it shows just how fast they're moving. They bought and integrated businesses so quickly, the dilution effect wasn't even in their earlier models. Yeah, they can afford that speed. They ended Q3 with net debt to EBITDA at a very manageable 3.0x. Plus, they constantly remind everyone about their structural capacity, over $5 billion a year for capital deployment.
And that capacity definitely wasn't sitting idle in Q3.
Yeah.
Let's talk M&A. They put $1.3 billion towards the Subsplash acquisition, plus multiple strategic bolt-ons. We saw new names like Convoy getting folded into Date, and Orchard Software joining Clinices and Lab Software.
Yeah. The strategic consistency is clear, isn't it? They're targeting these very defensible niche vertical software leaders. But hang on a sec. You mentioned the $5 billion plus annual deployment capacity, and yet they also announced a new $3 billion share purchase authorization. That's quite big. Does this buyback signal maybe they're finding fewer top-tier acquisition targets? Or perhaps they think the stock's just cheap right now?
That's a really sharp question. I don't think it signals a lack of targets, personally. I see it more as providing, well, tremendous optionality. They structured the buyback as open-ended to be used opportunistically depending on the market. So if the market hammers the stock because of, say, macro fears or maybe some noise around integrating deals, they have another way to deploy capital efficiently. It feels like a statement of confidence in the long-term strategy, really, a way to create shareholder value, whether capital goes to M&A or buybacks.
Okay, that framing makes sense, sort of a financial hedge against market swings. And focusing back on those bolt-ons, Convoy and Hanson D8, Orchard fitting into Cleansys. It really shows these deals aren't random. They're highly complementary, right? Designed to capture cross-selling pretty much immediately.
Exactly. And these M&A moves lead us straight into their next big strategic pillar, the AI transformation. Roper's pushing hard on AI innovation. Their stated goal is to become AI native. And they're talking about this across the board: product development, internal ops, customer experience.
Yeah, and what's really interesting is their specific view that AI isn't just about cutting costs or efficiency. They see AI as meaningfully TAM expanding, total addressable market expanding. The idea is if they use intelligent automation to offer new services or capture smaller, faster transactions they couldn't before, they actually grow the whole market they can serve. That's what fuels the long-term growth, according to them.
We can definitely make that AI ambition more concrete with the DAT example within their network software segment. If you look at how the digital freight marketplace has evolved, it really shows the scale of change. Think about the past. Running a freight marketplace was manual, super labor intensive. A trucker or shipper had to post a load, search for a match, then call to negotiate. Hours of work potentially for just one load.
Right. And now, they already have a pretty sophisticated end-to-end system. It combines, huge scale on the load board, data analytics, and integrated payments platform. It's already quite optimized.
True. But the future vision, that's the real leap. The intelligent end-to-end AI-driven platform. We're talking about taking that whole multi-step, multi-hour process and shrinking it down to one-click automation in seconds. The AI does the smart matching, the pricing, the execution, and just think about the implications for optimizing real-time load matching. That's basically the groundwork needed for autonomous trucking down the road.
And it creates this huge competitive moat, right? Because that AI foundation depends entirely on data, volume, and quality, just to give you a sense of the scale they're working with. DT handles something like 1.2 million load posts a day and 15 million rate lookups every day. That immense data advantage is why they believe they can win in this AI-native freight future.
Okay, that context makes the tech piece much, much clearer. So let's quickly pivot to how the actual segments performed in Q3. We can use this strategic lens, see where M&A had the biggest impact, and maybe where some macro headwinds popped up.
Sure, we can start with application software.
Yeah.
Revenue there got a big boost, up 18% overall in Q3. Organic growth was 6%.
Yeah.
So clearly, this segment benefited from M&A dollars. But internally, they saw good growth in Deltek's private sector business and continued SaaS momentum at Aderant and Vertafore. Vertafore especially seems like a prime candidate for that AI-native push.
Right. The nuance there, though, was Deltek. Management did mention political uncertainty hitting near-term demand, specifically in the government contracting the GovCon part of that business. That feels like a classic temporary macro headwind affecting a strong niche.
Exactly. Then moving to network software, that's where DT and Construct Connect live. Total Q3 revenue was up 13%, with 6% organic growth again. DT's growth continues, mostly driven by ARPU expansion, average revenue per user. So they're successfully monetizing that scale and data we talked about. And Construct Connect also showed strong ARR growth, apparently fueled by AI innovations too.
Okay. And finally, technology-enabled products. Q3 revenue up 7%. Again, strong organic at 6%. Neptune growth came from demand for ultrasonic meters. Verathon saw momentum in single-use stuff like B-Flex and GlideScope. The nuance here was important. Management specifically said tariffs impacted the timing of Neptune's growth, not the demand itself, but the timing.
So, okay, if you look across those segments, the underlying businesses seem quite strong. They're all hitting around 6% organic growth, even with those specific headwinds you mentioned. But that does raise a question, doesn't it? If they're pushing capital hard into these AI-native TAM-expanding businesses, why did they slightly lower the top end of their full-year organic revenue guidance? It was 6% to 7%. Now it's just approximately 6%.
Yeah, that's the key point of friction we need to understand. If the engine's running smoothly, why tap the brakes slightly on the outlook?
Well, it seems to be a mix of dilution and timing, basically. The underlying earnings were actually trending high, according to them. But the guidance change reflects the combined dilution from those Q3 bolt-ons we discussed. Remember that negative 5 cents in Q3? That adds up to a negative 10 cents impact for the full year 2025, which just wasn't in the previous guidance.
Ah, okay. So it's the immediate accounting hit from the new deals, plus those timing delays at Neptune due to tariffs, and the government uncertainty at Deltek. Those factors together explain why they narrowed the guidance range conservatively. It's not the core operations faltering, it's accounting for faster deployment and some external factors.
Precisely. Yeah. They kept the total revenue outlook the same, around 13%. They just narrowed the adjusted DPS guidance slightly to
Oh,
$19.95. It
yeah.
was $20.05 before. So it's a very minor tweak, really specific to those immediate costs and timing issues, not some fundamental shift in how the core businesses are performing.
Got it. And looking just at Q4 2025, they set guidance for adjusted DPS between $5.11 and $5.16. And that range explicitly includes another forecasted negative 5-cent impact from those Q3 bolt-ons, so they're baking that cost in right away.
Yeah. So overall, I think the quarter really just reaffirmed the strength of their model, that decentralized vertical software approach. They seem to be executing pretty flawlessly on their main goal: buy market leaders in niche defensible areas and optimize them for cash flow compounding. The aggressive M&A, the clear strategic focus on embedding AI everywhere, it signals a management team that's confident. Confident in today's results, yes, but also in their ability to keep evolving these businesses to grab new tech-driven market share.
It certainly feels that way. So, given Roper's aggressive M&A, that commitment to AI across the portfolio, it leaves us with a final thought for you, the listener, to chew on. Which of these companies they've recently bought or highlighted, think DA, Convoy, Vertifor, which one do you think is best positioned to really leverage this new AI native advantage and maybe see some outsized growth over the next, say, 4 quarters? What specific part of their data moat or their market position really stands out to you?